Hi there, everyone, and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Alrighty, so looking at our market today, we have come down to hold that 72 or 71.80 support level once again. All right, so as you know, through January, we pulled back on interest rate and Fed central bank fears. Okay, and we saw a correction. All right, market fell just a little bit over 10%, and now this is part of the rebound. Quite a few weeks back, I did say there's a very high likelihood we could very quickly get back up to this 200-day moving average, and it's exactly what we did last week. Okay, so now we've got the question mark. All right, this is the normal behavior, the move back up. Okay, you tend to make back at least half or a little bit more than half of a correction within a month or two after the correction happens. Okay, so I'm not surprised to see this move up. Now it's just a matter of whether it's going to continue higher and whether we're going to be able to test these highs again over the next month or so, or whether we're going to actually see it pull back to 7,000 again. Look, my gut feel at this stage is we'll probably hold through here at 72. Okay, and push a bit higher into that February period. We are in the middle of our reporting season at the moment, and it has been a reasonable reporting season. So I haven't got any real reason from that perspective that for the market to continue falling. There is a bit of fear out there, and we'll talk about that. And there's a few things that could cause the markets to roll back over again. And I'll talk about that through this video today. But for now, look, we're just eagerly waiting and watching to see what happens through this level. This is a key level of support here at 71.80, and yeah, that's going to tell us a lot if it holds or breaks. Coming across the US markets, they saw another sharp pullback last week on inflation worries. Looks like overnight, though, that selling couldn't continue. It tried to push through this 44 level, but we got a nice little reversal here. So, look, I wouldn't be surprised if it either pushes up from here or comes down and creates a double bottom and then pushes back up again. I'm not overly bearish this market, guys. I think the correction needed to happen. I think we're way overdue for a decent correction, and we've seen that correction come in. What happens next really is going to depend on a few things, and obviously that's going to be how quickly the Fed puts the brakes on, and obviously how bad things get between Russia, Ukraine, and the US. Okay. All right, so technically though, look, we're just waiting once again to see what level of support we're going to hold. If it holds here or holds down at 42, I will become pretty bullish. At any point if 42.80 breaks, okay, this support level through here, if that breaks, I'll definitely change my tune. Okay, if that level breaks, the market will be looking like it could turn into a bear trend for a while. All right, I don't think that's going to happen. That's not my view right now. But if technically that lines up, I will be very quickly readjusting my view and readjusting some positions. Okay. All right, so there's some key levels to watch, guys, from here on. We've definitely got some lower peaks and lower troughs. We want to see signs of that stopping. We want to see a double bottom or a bit of a change of trend happening through here. But if that support level breaks, yeah, we'll definitely have to be a bit more bearish there, guys. Okay, so CPI came in higher than expected in the US once again last week. Okay, we're seeing bits of volatility around these readings, in particularly that every single reading we've had recently has been a bit higher than expected, and those expectations are going up, not down. Okay, so I guess that's one of the big things you've got to watch out for is any sort of forward data on inflation outlooks and things like that can get the market a bit squirmy right now. The more we hear this, though, I think the more the market's just going to get used to it. Like we saw the pullback end pretty quickly from Thursday to now. Okay, so at this point in time, the futures are pretty flat. They've been hovering between the green and the red all day. So it doesn't seem like we're getting the same sort of fear reaction to what we did last time. And this happens. This is common when the market starts getting, forming corrections on the back of some news like this. It gets used to that news and it prices it in. And I think we're starting to see that now. Yes, we're still seeing some volatility, but nowhere near as bad as the corrections we've seen recently. So really, it's all about the Fed. Okay, throughout most of last year, the Fed was pretty comfortable that the inflation was just transitory, and for the most part, they're probably right. Okay, what they weren't right about is how bad the inflation might get and for how long. I don't think they were betting that it was going to continue through 2022. I kind of feel that they might have thought it would be over by now. So the problem now with the inflation is that the Federal Reserve has got a lot of pressure on them to do something about it, even though most of this actual problem is being caused by supply chain problems that was caused by COVID. Now, COVID cases are coming down week on week now. Okay, worldwide cases are down to about 16 million and topped out at 23 million. If they continue to drop at this rate, hopefully we might see an end to this supply chain bottleneck in the next sort of 3 to 6 months or so, right? Hopefully, as long as there's no other variants or anything like that. So look, the Federal Reserve, it's a funny situation right now. Are we scared of interest rate hikes? No. Right? Generally speaking, interest rate hikes historically have been positive for markets. Are we worried that the Federal Reserve might go hell for leather and hike too quickly whilst tapering off QE and running off the balance sheet? Yes, we're worried about that. Okay, will the Fed go too hard too quickly this year and decimate the economy? That's the fear point. It's not the interest rates themselves. Okay, we're not fearful for short-term increases in interest rates. It usually means that they think the economy is strong enough to handle it. It's usually a positive sign for equities, guys. Right? We don't want them to do too much too quickly, though. Okay, that's what everyone's talking about. You had some of the big US banks out there talking that interest rates could go up 6 times this year in the US. That type of rhetoric, that type of talk is what creates fear. Okay, that's what puts the fear out there to everybody. A couple of rate hikes, if they do 0.5% March, that's nothing. If they go again maybe in July, August after that, fine, right? If they start hiking 0.5% every month, every time they meet, then the market's not going to be happy. All right. So that's the real thing we've got to watch over the next 6 to 12 months is what the Fed says, what the members continue to say, and in relation to the inflation. If inflation starts calming down a little bit, then all this comes off the table. Okay. So they're the little things to watch out for this year, guys. Okay, we could have a couple of corrections in this market. I would not be surprised to see this market rise again, correct again in May, right? Or even rise again and correct again in March. What you have to remember is we'll see the Fed minutes this Thursday. We've seen the inflation last week. We've got a few Fed members talking this week. Once we get through this week, we probably see that whole talk around inflation calm down again for 2 or 3 weeks. And then we worry about it middle of March, because middle of March is when the Fed meets, and that's when we expect rates to go up in the US. So yes, we're seeing a little bit of volatility here, but from the Fed point of view, I think things will calm over the next few weeks. We'll see the markets lift back up again, but then we're going to have to watch out around middle of March when we get closer into that Fed meeting. Now, obviously, the other thing that's simmering around in the background is Russia and Ukraine and what's happening with NATO, and the NATO countries getting involved there. So things seem to have escalated a little bit overnight. That's what the media says. As the media spruiks, it's causing fear, it's causing a bit of volatility in the market. Usually, the markets will shrug this sort of stuff off fairly quickly. I will say though, we could still see some volatility around this. So in the short term, yes, it's going to cause some noise, but I feel in the longer term, it's probably likely to be a buying opportunity. Okay, so they're the real two main things I'm watching play out right now to help me time my trades is how bad things are getting with Russia and Ukraine, because that could cause another correction on our market. But also the bigger thing than Russia and Ukraine to me is what the Fed will do next and whether they will put the foot on the brake a little bit too quickly this year and continue to spook the markets. Okay, so the Aussie reporting's kicked off fairly well. We've seen a little bit of a lift in many stocks that have come into reporting, although probably not as strong as what we've seen in some other reporting seasons. And that could be a few reasons. One, obviously, we're following leads from the US at the moment, and we're seeing the fear around the Fed and the Ukraine situation, as I said before. But you know, there is generally a bit more uncertainty out there this year than what there has been for a little while. The market's had a nice little cushion under it with all the stimulus. Okay, now most of that stimulus has been pulled away, but we still have a epidemic problem out there. The Omicron wave was much bigger than previous waves, although not as deadly. So these are all the things to watch out for. What I'm we're sort of feeling at the moment, guys, is that although there's some nervousness out there at the moment, a lot of these issues are temporary issues. All right, this Russia-Ukraine could get resolved tomorrow, next week, or next month. The whole Fed thing, well, if inflation comes down, that gets resolved pretty quickly as well, and that will push the Fed off its current path or potential path of raising interest rates, or hiking them too quickly. So, these little things that the markets are worried about could peel away pretty quickly, and then we just get back to normal trading. And that's what I feel could happen in the short to medium term here. But don't get it wrong, guys. Volatility's high. Bad news is going to cause the market to move lower and move lower quickly. So just keep an eye on the VIX, keep an eye on the XVI, and keep an eye on those 10-year bond yields. If they continue to shoot up quickly, volatility stays high, and we get a bit of bad news out of the whole Russia-Ukraine situation, we are going to be volatile in the short term. And in this volatility we see in the short term will likely end up being a buying opportunity though. All right, so this year is a good year for doing some trading, guys, but you've got to be patient and you've got to time things right. And you've got to be prepared to close things out if bad news comes around. Okay, because you will get a shock down, but it will buy back up again. And those shock downs will always, well, I think this year will lead to buying opportunities. All right, so that's really it to talk about now. The BHP report was positive today, but it might be fairly well priced in here, depending on what iron ore does next. Iron ore is coming off after Lunar New Year, as it often does. So you might see a little bit of weakness here, even though BHP reported extremely well. Fortescue will be reporting tomorrow, and that's going to be another big one that we'll be watching around those iron ore stocks that are doing quite well. All right. Okay, that's it from me today. Thanks for listening in. Take care and bye for now.